Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will record an advanced payment from a customer within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are on the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be recording a payment from a customer, but it will be an advanced payment from a customer, meaning we're going to get paid before we do the product or service. In this case, giving the product, we're selling guitars. Therefore, we're going to get a payment before we give the guitar away, and that means that we haven't earned the revenue at the point in time that we got the money. This is a little bit more unusual of a transaction. Not all types of companies will have this type of transaction because normally the process would be that we get paid at the point in time that we do the good or service, or at a later point in time, not typically before. But certain industries we do get paid before many times. With the case of a guitar or something like that, we may be asked to hold on to the guitar and therefore get advanced payment in order to do that, for example, and then provide the guitar later. Something like a concert where we sell tickets before the concert actually happens should go into some type of unearned revenue, as we will show here. We'll have a similar situation, in other words, as we will show here. So to do that, we're going to select the plus icon up top, and we're looking for the customers section over here, and we will have the receive payment here. Funny thing about this is it's not going to go through the normal flow. The normal flow for customers would be that we either have an invoice and then we receive the payment at a later point in time in the mail, or we have just a sales receipt, at which point we made the sale, gave the guitar away, and got paid at the same time. What we're going to do is use the receive payment, which is usually what is used after an invoice, but record it before we actually have the invoice. That's what's going to be a bit unusual. When we select receive payments, we have this screen here. Receive payments means that we've got some type of money, and that typically will increase some type of cash type of count. This one's going to increase the undeposited funds until we deposit it into the bank. We're going to say that Anderson Guitar gave us some money. The scenario is going to be that they gave us $250 at this point in time, and we did not yet give them a guitar. What we did is we said we're going to hold on to the guitar for a later point in time. So they gave an advanced payment. The $250 will be going towards the guitar that we will provide at a later point. At this point in time, no invoice has been made because we have not yet given the guitar, and the $250 we're getting, we really haven't yet earned. So we're going to say that Anderson Guitars, we could select the drop down and or type in Anderson Guitars, and it will populate for us. We then have kind of an error signal here. It's saying, Anderson Guitar payment doesn't have an open invoice. So if that means that there's nothing to link it to, typically when we have a received payment, we will have some type of invoice that we will just check off and click on down here. At this point in time, they're saying, hey, you're getting a payment for what? You didn't do anything. You haven't given a guitar. You haven't done any service. Why are you getting this payment? And so we're gonna say, well, that's okay because we got the payment before we're going to record the invoice, which is, once again, a bit unusual. So we'll tab through this, and we're going to say that this is 02/16/21 is the date. We're going to be working in February 16th, 2021. Note, when I say that it is unusual, by the way, it's unusual for most types of companies. It could be a normal transaction for certain types of companies, such as if we have a concert, or if we sell magazines, or any type of subscription service at these days. Those are all types of businesses where we get paid before we provide the service, and we will have a similar situation with those types of industries. So we're going to say here that the payment method, I'm going to say that it is a check. So I'm going to say it's a check that we got, and we're going to say the check number is 5243. It's going to go into undeposited funds. We're not going to put it in the bank. That's just the same as normal. We're going to group them together and then put them all in the bank at the same time. The amount then we're going to say is we got $250 as the down payment on one of the guitars that we will later be recording. And that's going to be it. Note there's no other invoice that we have here. So what is going to be the journal entry here? A little bit different than possibly you may be thinking from a theory type class, which you would say, we got a prepayment, we got money for work that has not yet been done, which means that cash would go up. Cash is kind of going up, but it's undeposited funds, so it's not going in the checking account yet. And the other side typically wouldn't be revenue because we haven't earned it. It's not going to go into revenue, and it should go into a liability, undeposited fund. I mean, a liability called unearned revenue, typically, or some type of unearned liability type of account. Note that the receive payment option here, though, typically means that we're going to reduce a accounts receivable account. So a receive payment form typically means accounts receivable will go down. Problem though, accounts receivable doesn't have anything in it related to an invoice for Anderson guitars, and therefore when we bring the accounts receivable down, what we end up with is a negative receivable, meaning it looks like we owe Anderson guitars, which we do. We owe either the $250 back or we owe them the guitar in the future. So that shouldn't happen. We shouldn't have a negative receivable. We should have a liability that's going in the liability direction, not a negative receivable. This works really well for QuickBooks, however, because the negative receivable allows us then to create an invoice, and the invoice will match up against that negative receivable, meaning the subledger that we track this negative receivable in by customer, Anderson Guitars, will work great in this process. However, until we match it up, it's not quite right. So if we make the financial statements as of the point in time that this is still outstanding, we'll have to do an adjusting entry, as we'll see, to really kind of correct the fact that we're creating a negative receivable instead of a positive liability. So this is one of those areas where functionality, logistically, this works quite well. Not exactly correct in terms of GAAP or generally accepted accounting accrual principles. And we'll see that in the adjusting process. So let's save this and then take a look at it. We'll close this back out. We're going to go to the reports left side. We're going to go to the balance sheet. I'm going to say balance sheet and open up the balance sheet and change the dates to the month of February 02/01/21 to 02/28/21, February 1st, 2021 to February 28th, 2021, and run that report. Then if we scroll down in the undeposited funds, we see that 250, that's where we put the funds until we go to the bank. There it is there. There's the 250 that we put the funds until we go to the bank. And here is our receive payment item. Closing that out, scrolling back up, going back to our report, back to the balance sheet. The other side then is not in a liability account called unearned revenue, as it should be. It shouldn't be in revenue because we haven't earned it, but it should be in some type of liability typically. We put it, however, into the receivable account, which is $965. If we look at the detail there, then we see the 250, that's a negative. It's bringing the receivable down. However, even if we go back to the prior month, if I go back and I change the date range here to January 1st, 2021 to February 28th for this transaction detail report and run that report, we don't see anything matching up against that 250. What we should see is the account going up like this and then going back down. And that should be the typical trend we see when the receivable goes up and then it goes back down. Here we have this going down and there's no corresponding increase prior to this. And that's what's unusual. So note the receivable is still positive. It's not like it gave us a negative receivable in total, but the receivable should be 250 higher and we should have a liability of 250 rather than having the receivable decreased by this 250 here. To see this more clearly, let's look at another report, which will be a report by the receivable report by customer. So we're going to go to the reports left side. We're going to go to the customer balance detail. We would like to see the customer balance detail report. We will select that report and run that report, customer balance detail. And what we see here when we run this report is we see the same total, $965.27. However, if we break this out by customer, Jones looks normal. We got $399 owed there to us. They owe us $399. Music store stuff owes us $816. And then we have this negative receivable, meaning it kind of looks like we have a receivable in which we owe them $250, and that's what it means, because we owe them $250. We're not going to give them $250. We are hopefully just going to give them the guitar to complete the transaction that we have started by them giving us a down payment. However, it shouldn't be that we owe someone something in the receivable. It's an asset. The fact that we owe somebody else means it's a liability and should be in the unearned revenue. So this works great logistically because, once again, once we have the invoice for Anderson, it'll match up to this amount, and this subledger, this customer balance detail, will be correct. However, until that happens, it's not quite right. So it's going to be just one of those little quirks that logistically works well. You see this a lot in practice. You won't see it so much at all in a theory kind of textbook. Hello, in this presentation we will record an advanced payment from customer within QuickBooks Pro 2018. We will continue working with the Get Great Guitars problem. If you've been working along with us and you have the backup, you can restore that backup by going to File and Restore. If not, that's okay. We will be recording an advanced payment, meaning we're going to receive payment from a customer for work or goods that have not yet been delivered. Could be thought of as a deposit. We're getting the money before the work has been done. In this case, the work being the delivery of a guitar. If you have the home page open, that's what we're going to be starting out with. If not, we go to the company and the home page. Also going to have the open windows open. We can get there by going to the View tab and Open Window List. We currently only have the home page open. The scenario here is going to be that we sell guitars and we are going to receive an advance payment from a customer. We can think of it as a deposit. So if we had to order the guitar custom for a customer, we may require an advance payment on it, and therefore we're going to actually get the payment, receive the payment here before we create the invoice. And what are we going to do when that happens? Clearly we're going to debit some kind of cash account, in this case undeposited funds. But we can't credit revenue in this case. We haven't yet sold the guitar. We want to connect these two things, but normally we can see the process going from create invoice to receiving payment. And in this case, we're going to receive the payment, get the deposit before we create the invoice. So once we create the invoice, then after the point that we receive payment, we'll be able to tie those credit amounts out. We'll also take a look at what happens in terms of the financial statements, which accounts will be affected, and what's going to happen to the aging account, or how is that receivable or going to be put in place in terms of a negative receivable in this case, or something that we typically owe in terms of a liability. When we record this in terms of normal accounting, generally accounting principles, we would say debits or increase the deposit, the cash, and then we would credit not revenue but undeposited funds. We're actually going to work it a little bit differently because of the format of QuickBooks and because it helps us with some of the reports, and we'll talk a bit about that. So we're going to say receive payments, and we're going to have our guitar, our customer is going to be Anderson. So we could select the drop down, or we could just type in Anderson and start to type in that, and we're going to say the payment is going to be for $250 that we are receiving. The date is going to be 02/16/21. We are working in the future. We will keep it as a check. We're going to say the check number, an optional field that we're getting a check from the customer. This is not a check that we are writing. 5243. And that's going to be it for the customer payment. Note that when we record this, we're going to have the $250, but it's not going to be deposited into our checking account. It's going to go into the undeposited funds. Normally, the credit would be decreasing the accounts receivable for an invoice that we have outstanding here. Now, we're still going to be dealing with accounts receivable because that's basically what the customer payment function does. But since we don't have anything to apply it to, because we have not yet created the invoice, because we have not yet delivered the guitar, what's going to happen is it's going to create a negative receivable. So when we go in and take a look at the receivable for this customer, Anderson, we'll actually have a negative receivable. That's not exactly proper in terms of accrual accounting, because we should have a liability, not a negative asset, not a negative receivable. However, it does work well for us to connect this deposit, this prepayment, to the future thing that's going to happen when we actually make the invoice at the point in time that we deliver the goods, in this case the guitar. So we're going to say save and close and see what that looks like. It says a credit for the overpayment will remain with the customer. We're going to say okay, and we're going to apply that credit to the customer when we create the invoice. So then we're going to go to the reports and see what happened. We're going to go to company and financial, scrolling down to the balance sheet. We're going to change the date range so that we can see the drill down on the date range. And we're going to say it's 01/01/212/12/31/21. There's the date range. Okay. So we have the date range there. Now, we know the received payment did not go into the checking account. It went into the undeposited funds. So if we double click on the undeposited funds and scroll down, we see that we have the Anderson guitars, the 250. If we double click on that, there is our customer payment. If we close that back out, closing this back out, the other side of it is going to be in receivable even though nothing was due at the time. If we double click on the receivable and we scroll down, we see the 250. Now that looks normal until we see the fact that there's no related invoice to this payment, as there typically would be. For example, we see this 430 and then this 430 going out. And we see the 399 and I don't see the 399 going out, but we see the 525 and we see the 525. That's going to be the normal process for the receivable. In this case, we've got something, a payment, but no invoice, which typically would be input before the payment. So let's take a look at what that looks like on the accounts receivable detail. And note here, however, that this amount should then be reported as a liability, which will make more sense when we look at the detail. So we're going to go to the reports. We're going to scroll down to customer receivables, and we want to go to the customer balance detail. And if we look at Anderson, we see that we have this 250. Again, it's a negative number, and that means it's a negative receivable. That shouldn't be, because a receivable means people owe us money. A negative receivable from this customer means we owe them money, which means that it's a liability, not an asset. So this is not something that would be under generally accepted accounting principles, meaning if we look at our total balance sheet number, which added up to 965, it should be higher by 250, and we should have a liability of 250. However, this system works really well for us to be able to track everything by customer and then apply the invoice out to this amount in the future, as we will do. So in essence, we're going to do this in practice so that we can make that connection, so we can have software of QuickBooks make that connection. However, when we do the adjusting entries at the end of the day, when we're trying to make our financial statements in accordance with GAAP, then for financial reporting, then we're basically going to do an adjusting entry to take these negative amounts out and create a liability for them.